The two best quality stocks to buy in the stock market right now. This is what I'm gonna talk about in this video. And the best part is that those stocks aren't trading at fair value. I believe they're nearing undervalued territory, which isn't common with a lot of the good companies. Most good companies, they never get undervalued. They trade mostly at fair value. But this is an exception. I did find those two stocks. I'm gonna talk about them. And I really hope you enjoy it. If you do, let me know in the comments. Press like, dislike, whatever you feel. Let me know what you feel and ask me anything in the comments. Okay. And the first stock I'm going to talk about, which I talked about it on X, and a lot of you liked it. I got a lot of attention on the stock. A lot of people loved the idea. They didn't think about it. And this is CNI, which is Canadian National Railway. It's down 17% year to date. Not a lot of you thought about this one. It's gone under the radar. I don't know why. And railroads are just an amazing kind of business model, beautiful, wide moat. You're just not gonna go and build another railroad. And those railroads are gonna last forever. AI is not gonna disrupt them. Nothing's gonna disrupt them. So this is like a buy and hold forever kind of business. That's Buffett loves them and people like that stuff. Even Bill Ackman owns a railroad company. And people love that stuff. And they do have a wide moat, 15% return on invested capital, 18 PE versus 21 for the mean 5-year mean PE. 12% EPS growth, and I did say that I believe CNI is presenting one of the best buying opportunities in the stock market today, and I'm gonna tell you why. Now, a lot of you told me, why did you talk about CNI and not CP? I have nothing against CP, and I talked about it many times. And CP has a much better network than CNI. CP is the only railroad company, I believe, that connects Mexico to the United States to Canada, all within one network. But at this price, in my opinion, CNI is the most undervalued railroad stock in the stock market. And that's why I decided to talk about it. But CNI is a railroad company. They have a network from Canada into the United States in many different cities, Chicago and other kind of places, Canada, United States, many different things in terms of petroleum, chemicals, fertilizers, forest products, metals and miners and automotive and coal and so many different things. And they do a lot of stuff. And there's two main reasons, or I should say three main reasons why the stock has been going down. The first one is they had a weak quarter in terms of the last one. And it was partially due to a lot of the strikes that were going on many different ports. And there were some union strikes and different kind of things in terms of labor. So this is one reason. But a second reason why the stock has been going down is because of fears of tariffs between the United States and Canada, that the new administration might put certain tariffs on Canada, and then any shipments coming from Canada into the United States, maybe it will decrease some volume in terms of shipments, which in this case it would affect CNI in terms of volume. And that would be very bad for CNI's business. But I believe in terms of the valuation, a lot of that stuff is kind of getting factored in the price. And that's what I'm going to talk about. And if you don't want CNI, by the way, I'm going to talk about an alternative that's mainly in the United States, which you're not going to have any tariff risk. But those are the main reasons why the stock has been going down. But I really like that CNI's management tracks return on invested capital. It's a good metric to track, 14, 15, 16%. I like it very much. They do track it very good. They do buybacks and dividends. They've been doing dividends for over 28 years, no dividend cuts, I believe, since 1996, 15%, average annual growth. Now it's $3.38, which is around 2.5% dividend, nothing too crazy, but it's a decent dividend. And they also do share buybacks whenever they believe the stock is looking undervalued. They have a 2-year guidance, 2024 to 2026, which I like. They have earnings per share growth, 10 to 15% CAGR. That's amazing. And they also have certain targets in terms of their balance sheet. And their balance sheet isn't crazy over leveraged. It's very good in my opinion. And it's trading at a discount. It used to trade at 21, 22 times earnings, as high as 25 times, as low as 15 times. And that was during the COVID crash. And now you could buy it at 18 times earnings. So once this whole tariff drama and the strikes and all that stuff is over, there's a very high chance that CNI is going to get back to 21 times earnings. And it could happen very quickly because, trust me, those kind of railroad stocks, they very rarely get discounted, very rarely. And I bought them and I made money with them many times. My only mistake is I didn't hold them, because whenever there was a multiple expansion came back and I got my multiple, then I sold them. That's what I did with Union Pacific back in 2018. I bought it at like 170 or 160 and I didn't hold it. So that's a mistake. So if you do buy CNI, just hold it, don't sell it. Not financial advice. But this is another saying where if we have all this drama that just goes away, there's a very high likelihood of a multiple expansion back to 21 times. And you're getting around 12 to 13% earnings per share growth per year. So I believe you could get 12 to 13% kind of annual returns with CNI over here, excluding a multiple expansion. With a multiple expansion back to 21 times, I believe easily around 14, 15% kind of annual returns with CNI, maybe a little bit more in the short term if we have a change in sentiment and the whole thing around tariffs fades away and after the first half of 2025, maybe 20, 25% next year. I mean, the stock is getting discounted. And it doesn't happen very often with a lot of those railroad stocks. I mean, the lowest it went to was 15.5, and that was in COVID. Now it's trading at 18 times. So I don't know how much lower it would go. And I believe it's presenting a good buying opportunity. Now, if you don't want to deal with the whole tariff situation, there's CSX, which is mainly in the United States, mainly in the United States, as I said. It doesn't have as much of a discount as the other one, 17 times versus 18 times. For the mean, and it's growing 9 to 10% instead of 12 to 15%. And this is the main thing. Now, the second one, which I haven't talked about in a while, and it's trading at a very low level, and I don't know for how long it's going to last. And this is EVVTY, which is Evolution Gaming, is down around 29% year to date. If you're not familiar with the business model, they create the online gaming and online betting that maybe if you go on something like Caesars or any kind of iGaming online betting websites you use, they create the game for them, and you, the end user, you play on the game and you pay the gaming operator. And the gaming operators, they pay EVO for the game, variable commissions, and fixed fees. And it's mainly a bet on most of the casinos going from land-based to online casinos. Now around 25% of them are online, and it's been rapidly growing, as you could see over here. Live Casino and RNG have been growing at 20 to 24%, and land-based has been barely growing, and most of it is going online. And if you're betting on that stuff, Evolution Gaming is an amazing way to do it. For example, they have very recently renewed a partnership with FanDuel. I can find over here 3-year partnership with FanDuel Casino in the United States. That's an amazing partnership between the two. The company has an amazing market share, 39%. In terms of online gaming and online betting in general, 39% market share. This is amazing for the company. And as you can see, in terms of total revenue, it's been slowing down. And the main reason why it's been slowing down is because the company depends a lot on legalization. So they want more countries, more states in the United States to legalize for them to grow their revenues. There's only 2 ways they can grow their revenues, or mainly 3 ways. The first one is with more adoption, meaning if more people bet online and do certain things online, that could grow their revenues. The second reason they could do it is if they launch more games and they could benefit from that. The third one, which is the most effective one, is if more countries and more states legalize and they can expand into new markets. So a lot of their growth is largely dependent on regulations and legalization. And this is the main risk with the company in terms of the growth. So they're not really in control of their growth as much as other companies. And that's why the company kind of trades at a discount. And if you look at the last quarter, there was a lot of one-time revenues that they had. So they had 59 million of one-time revenues. And that's why revenues, for example, if you take the 59 million and you look at the total revenues, and you take it out, it wasn't really up as much as it was. So the growth is slowing down in general. And I did blame the quarter on some one-time events like, cyber attacks or whatever, and something what happened in Georgia in terms of strikes on their studios. And there's a lot of one-time stuff. There's a lot of noise, but the stock is cheap. And I'm going to show you why it's cheap. And the management is actually doing something about it. And they've been buying back a lot of stock at very low prices, around 700,000 shares, 591,000 shares, 335,000 shares, 200,000 shares, 150,000, 67,000. So they've been buying back a lot of shares at those prices and creating amazing value for shareholders. And they also have a dividend. And the stock right now is trading at 13 times earnings. This is dirt cheap. 13 times earnings for 53% net income margin, or around a 7.5% free cash flow yield for a company that, yes, the growth has declined from 80% to now 8%. But looking in the future, after those one-time events, it's expected to grow around 13 to 14%. So it's not like the company is declining in revenues or in earnings per share. It's still growing, but the growth has decelerated. But at 13 times earnings, or 7% free cash flow yield, in my opinion, the company is priced like it's never going to grow again. With such balance sheet, with 53% net income margins, this is dirt cheap for the company. It's very, very undervalued. I don't believe it will ever trade at 27 times or at 54 times earnings ever again. I'm just being honest. But I could easily see it trading back at 17 to 20 times earnings if the growth does pick back up in 2025, and they believe it's gonna pick back up because they said they're launching a lot of new games, and that's what it looks like, and they're buying back a lot of stock, which is gonna help earnings per share into next year. It'll look a little bit higher, and this is how I see it. I mean, the company is good. They still have an amazing market share, around 40%. Legalization, I don't know what's going to happen with a lot of countries. But even if they don't grow a lot from here, 13 times earnings or 7.5% cash flow yield, it's cheap for the company. It's just very cheap. I don't know for how long that's going to last. And I talked about it a lot. I don't want to talk a lot about the company, but I like it very much. That's my second one. My favorite one is probably the first one, CNI. I like railroads very much, and I believe it's one of the best one in the market. And I don't know for how long that's going to last, but that's my favorite one. And those were my two picks for the video. I hope you enjoyed it. Not financial advice. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.